Hello and welcome back to Strategic Alternatives, the RBC Capital Markets podcast. I'm your host for this episode, Joe Coletti. Today we continue our special series based on RBC Imagine research, which explores the transformational forces reshaping industries, economies, and societies. In this episode, we're zooming in on China's growing dominance of the global auto industry. We'll explore how geopolitics, intense competition, consumer preferences, and the strategic moves of manufacturers in China and elsewhere could shape the electric vehicle market. I'm joined by Tom Narayan, our lead equity analyst in global autos at RBC Capital Markets, who's just published a report examining how Chinese original equipment manufacturers, or OEMs, are rewriting the global auto playbook. Tom, thanks for coming on the podcast.
Yeah, thanks for having me.
So we know that China has long had the edge in electric vehicles, not least because they have access to the raw materials required. Do you think that dominance is likely to continue?
Yes, definitely. China benefits from the control of the battery supply chain. It starts from the processing of raw materials like lithium, cobalt, nickel, to cell manufacturing, and also benefits from decades of big state subsidies, low labor costs, greenfield EV facilities, and a fast iteration development culture. Plus the fact that the domestic Chinese market is the biggest in the world. In 2025, Chinese OEMs held about 65% of the domestic EV market. We see this reaching 80% by 2030.
So given all those advantages that you cited, it's perhaps not surprising that Chinese companies have a pretty tight hold on their own domestic market. But how far are they also eating into Western manufacturers' markets right now?
Yeah, this year, some Chinese OEMs have boosted their exports to Europe and Southeast Asia. And that's because China actually cut their domestic incentives for new energy vehicles, that is, EVs and hybrids. They did this to ease the pricing war there, which hit demand slightly. But more significantly, Chinese OEMs are also localizing aggressively in Europe. Examples of this include BYD in Hungary and Turkey, Chery in Spain, Leap Motor through its Stellantis JV, and XPeng through its Magna partnership in Austria. So because of tariffs between China and Europe, we think the Chinese OEMs that localize are more likely to grab significant market share. But it's hard to know if they can retain their cost advantage in localized form when they're obligated to use Western suppliers and comply with EU regulations. We saw a similar phenomenon in the 1960s with the Japanese auto entry into Europe that achieved some limited success. And some argue this is because Europeans prefer homegrown brands. But we think rising fuel costs and tightening carbon regulations will give China a better chance in today's European market.
So can you talk about the implications of all this for Western companies in the sector? Like what is that changing? How are things going to have to evolve? How are they going to have to change how they compete?
Yeah, despite continuing China dominance, projections suggest that European OEMs will grow production too, albeit gradually. And while losing European market share to China, some investors flagged the risk of Chinese suppliers that could come in and displace Western incumbents due to Chinese localization. But we think Western suppliers will actually be net beneficiaries of this trend. As I mentioned, EU standards could compel Chinese OEMs to use Western suppliers abroad. We're not sure Chinese suppliers have the financial capacity to localize in Europe in the short term, and order books for suppliers in our coverage are increasingly weighted towards Chinese OEM customers.
What about North America? Is there potential for Chinese OEMs to make more significant inroads in the market here?
Yeah, it's a really important question. Chinese OEMs are technically prepared if they decided to penetrate the US market. Younger US consumers in particular are open to Chinese vehicles. And in our recent expert call with Sam Chung, our expert estimated that Chinese OEMs could ultimately take 20 to 25% of the US market. However, Chinese OEMs are naturally cautious about this because of policy volatility in the US. There's currently a 100% tariff on Chinese auto imports to the US. So we think market entry will be very unlikely in the near term.
How are EVs themselves evolving in technological terms? And also, what role do you think consumer preferences are going to play and how these markets start to shape up?
Yeah, one difference in the Chinese market is that autonomous features are already the norm there. This takes the form of L2++ features. For example, not fully self-driving, but allowing things like hands-free or semi-automated driving under certain conditions. Chinese consumers are younger, they're more tech-forward. They don't see autonomy as a luxury, but rather as an everyday practical tool to help them navigate megacity traffic. They've also embraced features like in-car karaoke, which are obviously not the norm in Western markets. Some global OEMs are recognizing their Western-built systems don't fit Chinese expectations and are partnering with Chinese players to develop products for that market. The broader question about what happens if L2++ is embraced in Western markets and whether it will be a premium product, that's really a question that we'll need to see how it takes form. The next phase is level 3 autonomy, eyes off, hands off driving, which may be the point at which buyers are willing to finally pay a premium. They don't have to drive finally. But the auto industry has a long history of absorbing valuable features into the product without managing to raise prices. But only time will tell how this all plays out.
So, Tom, I want to close by having you maybe sum up what are really the big takeaways that you want people listening to understand and to walk away from the conversation we're having with what's happening and what China's influence over the EV market could continue to become in the years ahead.
Yeah, I think the bottom line is that the Chinese are not only coming, they're already here. They're going to penetrate the European market, and they will eventually reach the shores of the US. Now, how will that take place? That's an open question. They'll probably utilize the local labor supply and supply chain, so it may not be as problematic as a lot of folks fear. But make no mistake, the Chinese will have a very big impact as the auto complex evolves, both in Europe and, yes, in the US. But we do think ultimately Western OEMs will survive. And we do think that the supply base will modify and adapt. They may even be net beneficiaries. But make no mistake, the Chinese are not only coming, they're already here. They're going to have a pretty big impact.
It's going to be fascinating to see how that all plays out and how China's role in the markets across the world continues to evolve. Tom, thanks for taking us through the headlines of your report, which I want to remind our listeners is called Made by China. And if you'd like to get access to the full RBC Imagine report, please contact your RBC representative. Tom, look forward to having you back on the podcast again in the future.
Thanks a lot.
You've been listening to Strategic Alternatives, the RBC Capital Markets podcast. This episode was recorded on July 2nd, 2026. Listen and subscribe to Strategic Alternatives on Apple, Spotify, or wherever you get your podcasts. If you'd like to learn more or continue the conversation, please contact your RBC representative or visit rbccm.com/imagine. See you all next time.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.